Hey, what's up everybody? My name is Sleem and today I'm going to be going over candlesticks. No, I'm not talking about things that make your house smell nice and pretty. I am talking about a charting method, so how to plot out a stock's price and actually analyze it and get something from it, opposed to just looking at a line chart that shows you that the stock is going up, down, or sideways. So bar chart is another way that you can plot out your charts, but in the past I've really liked using candlesticks. It's worked for me. Now, I can't say that it's going to work perfectly for you, but the majority of traders that I talk to use this method. The Japanese brought this into play in the 17th century, and people have been using it ever since. I think it was introduced in the US in the 1900s. If it worked then, it works now. It has to be pretty good, right? So let's get started. Candlestick Basics. I created this little diagram for you all to show you the two different parts of a candlestick. And it's fairly simple. So these big fat rectangles right here are called the body of the candlestick. And then these wicks right here can be referred to as, wicks or the upper and lower shadows. So the lower end, obviously the lower shadow, upper end, the upper shadow. And essentially what these wicks tell you is the overall range for the stock, whereas the body itself shows you the opening and closing price. So if the candle is bullish, if it's green, then that means the opening price was obviously lower than the closing price, meaning that the lower end of the body was the open and the upper end was the close. Now, the shadow on the upper end and the lower end, these shadows indicate the overall range for that time period. So throughout this webinar, let's say that the time frame that we're using is 1 year, 1 day. So you're going to have 252 however many candles for the past year. And each one represents a day of price movement. Okay, so let's say this is for today. 9:30, ding, ding, ding. We open up. 4 p.m. we close. Okay, that's how it would work. Now, let's say that the stock traded between $1 and $2, but the opening price was at $150 and it closed at $175. Okay, so that would mean that we have no way to express the range. Well, that's where the shadows come in. Okay, so this would be $2, this would be $1. All right, so the bottom end of the candle, the lower shadow, the tip, shows you the minimum price for that time period, and then the upper end, this tip, shows you the maximum price for that time period. Okay, so it shows you the range of which it fluctuated, and then also the opening and closing prices. And it works the same way for a bearish candle, except it's flipped. So the opening price is at the top and the closing price is obviously lower because it closes lower than it opens. That means it's bearish. That means the stock went down during that time period. And then you can get the overall range from it based off of the shadows. Okay, so shadow and body. Those are the two parts of a candlestick. So analyzing different candlesticks can be a little complicated, but really the note that I want you to take away from this is that you really have to focus on the size of the body and the size of the shadow. Don't worry too much about the complicated names I'm going to throw at you during this, because if this is new to you, then all you need to worry about are the two different parts, okay? So as you can see here, the most bullish and most bearish candles are clearly the ones with no shadows whatsoever, and they're just a complete rectangle, 100% body. And that's showing you that it opened at this price, it closed at this price, and there was no other buying or selling pressure outside of that range. Okay, so it works same way bearish as it does bullish. Now, these get a little bit different, okay? The most or second most bullish candle would be the one with the longest shadow and, still closed green for that time period. So for the day, this means that we got a ton of buying pressure after opening up at this price. So it means that it dipped down during this time period, and there was a ton of buying pressure to drive it higher and close it higher, making it a very bullish candle. A normal bullish candle is just, minimal sized shadows, so not a whole lot of buying pressure, not a whole lot of selling pressure, and just a decent sized body. A neutral bullish candle is just one with, a big upper shadow, big lower shadow, and it shows that the bulls and bears fought a lot, but overall the bulls came out on top. Not very meaningful because it wasn't a huge win for the bulls. They did barely win the fight, but it's not a very meaningful bullish candle overall because there wasn't an overwhelming amount of buying pressure. Okay, And of course, this is a slightly bullish candle because it's pretty much the opposite of the very bullish candle over here. There's a lot of sell pressure, and they barely managed to close it higher. So same concept as the neutral bullish, whereas the bulls still won, and they came out on top. But overall, there was still a lot of selling pressure. So that's what you can take away just from the different shadow sizes, and it works the same way on the bear side. So as you can see, this is the most bearish candle aside from the one with just a full body, and because it closed lower and there was a ton of sell pressure holding it down because of that big upper shadow. Okay, so here we have pretty much even buying and selling pressure, so it's a normal bearish candle. Here we have the neutral bearish, works the exact same way as the neutral bullish, whereas bears came out on top, but at the same time they barely won. Okay, and the slightly bearish candle works the same exact way, whereas the bears still came out on top, but we still had a good amount of buying pressure on this dip due to the lower shadow. Okay, so here we have 3 different kinds of dojis, and a doji is something I'll go over in a second, but it typically indicates that a reversal might be coming. So this is called the gravestone doji. Don't worry about the name too much. All you have to understand is that the huge upper shadow indicates that sellers dominated it. All right, so it opened at the same exact price that it closed at. So that's exactly why it has that neutral color to it. Typically you see this in black, white, or gray, and you can change that in your charting platform, but that's just the standard. And as you can see here, we have a dragonfly doji. So this shows that the buyers clearly dominated because it closed at the same price that it opened at, and it has that huge lower shadow. And here is just a standard doji where you have even buying and selling pressure throughout that time period. And neither the bulls nor bears won, and we closed at the same price. So it doesn't necessarily have to be smack in the middle, but just so you know, a doji is classified, whereas the closing price is the same as the opening price, and typically it indicates some kind of reversal. And I'll elaborate more on that in a second. So here are the different positions of candlesticks. The ones that I've starred are the ones that I really only pay attention to. And that's something that you should really take away from this, is that candlesticks are good to get a picture of what's going on, but you shouldn't place trades solely off of candlesticks. That's just my opinion, just from experience, but if you place them solely on candlesticks, you will get absolutely crushed. You're not taking technicals into account, any type of indicators, any type of catalysts, volume action, any of that. So you have to actually factor in different things, but it's good to understand this side of things. It's good to understand the price action, the range, the body of each candle. So I've starred the ones that I typically look for, and here we have the first one. It's an engulfing pattern, and essentially what that's telling you is that the high and the low of the next candle completely engulfs that of the previous candle. So if it is bearish, if the second candle is bearish, then that means that this is a very bearish setup, and it could indicate a reversal to the downside. All right. So if this is flipped, if there's a bullish candle here, it's green, and this one is red, it's bearish, then that means that it's probably going to continue to the upside or reverse to the upside, and we have a very bullish chart set up. Okay. Now, as for a hammer, this is what we saw right here, the second most bullish formation, and it's pretty much indicating that this lower shadow gave it a ton of buying pressure. There was a lot of buying pressure during this time period, and even though the body is somewhat small, it still managed to close green. So a lot of buying pressure, closed green. That's a very bullish setup. Okay, Harami and piercing, I don't want to focus too much on and confuse you, but if you study up on them and you find that you like them, go for it. I just don't really care for them all that much. Doji, I'd say, is probably the most important one, and it's definitely the most different one because it actually doesn't have a color to it. It indicates that, of course, the bulls and the bears fought. Nobody really came out on top, and you can actually see the buying and selling pressure based on the shadows. So larger upper shadow, a lot more sell pressure. Larger lower shadow, a lot more buying pressure. That's the logic we've been going off of this whole time. Spinning tops, also very similar to a doji, but typically this is what you see on 1 year, 1 day charts because it's rare that we close at the same exact price that we opened at. So we'll see a little bit of a body and we'll see big shadows in either direction. And all that's telling you is that we probably got a reversal coming, and it kind of tells you almost the same thing as a doji, but bulls still came out on top. So if we're seeing a drop, and then we see a spinning top and it's bullish, then we're probably going to see a reversal to the upside. Okay, same thing for a doji. Drop, doji, reversal to the upside. If it pops, spinning top, reversal to the downside. Okay, so those are the basic positions that you have to be aware of. So now I'm going to go over the importance of candlesticks and then give you a few examples in my charting platform. Pros, you can analyze buying and selling pressure, you can compare it with volume, and you can actually improve your execution by utilizing these. So I'll go over each one with examples. So analyzing buying and selling pressure, it's pretty simple. As I said, you just need to you pretty much just need to evaluate the shadows and what the body ended up doing, but the shadows are really the crucial part there. So let me show you an example. So here we have a stock that I traded today, just a quick scalp, quick day trade, in and out on the long side. So made some good money off of it. There was a decent amount of liquidity, not a whole lot, but enough to make a quick couple $100. And regardless, it was a nice chart setup. I used technical indicators, I used my scanners, I used my strategy, but in the end, what actually made me sell was this candle here. And as you can see, this huge shadow up top is indicating a lot of sell pressure, and this small shadow down here is not indicating a whole lot of buying pressure. So I sold on this candle, and it ended up being the high for the day, and the stock dropped significantly. You can also factor this in with volume, which was the second point I made for pros. So if you compare this with the volume, then you have two things working in your favor and two things that you can analyze. It gives you a better picture. So the main thing you got to take away here is that if you get this candle with minimal volume, then it's not too big of a deal, because it just means a few people were buying and selling it, and they could have manipulated it, and made it seem like there's a huge shadow, whereas it's not as meaningful because it wasn't 10,000 people doing it. It was just 5 or so. Okay, so as this is the booming volume that I was looking to get out on, because it provides plenty of liquidity, I could tell that there was a lot of momentum present, that this was a very meaningful candle, as was the last one. And if I saw an ugly formation, I was going to cut it loose. And I did. And I cut it loose at 138, so actually just slightly lower than where it closed, because obviously this is the open and this is the close. And this huge upper shadow told me that we were going to drop lower from here, and there was a ridiculous amount of selling pressure. So I was in from 1.18 and ended up cutting it loose up there. So a pretty good gain in terms of percentage return, just putting size out of the picture. But as you can see, this booming volume means that this candle is meaningful. If we get any type of a, determining formation here, then we can forecast the price movement from here on out. Okay, and one thing I always tell to my members is when you get into a stock, you're always looking for a reason to exit. You don't need to be told 1,000 times. You don't need to see 30 sell signals before you get out, because at that point it's too late. That being said, you need to understand candlestick formations and realize that there's a lot of sell pressure here. Okay, so you can analyze buying and sell pressure with candles just based off of the shadows. You can compare that with the volume factored in so that you can get a better picture of what's going on. And then this also helps you improve execution. So this was on the 1 day, 1 minute time frame. And to clarify, this is in TD's Thinkorswim platform. But if we take this out to the 1 year, 1 day, and one stock that I was looking at today was VCEL. This stock I alerted short to my members as it popped over 2.5 because as you can see, basic supply and demand, and I can do another webinar on that. Basic supply and demand, when this stock pops above 2.45, although that might act as resistance, when it pops above that level, the past 1, 2, 3, 4, 5 times it has not held. That being said, what makes this time different? There was no catalyst in play. There was no news. So I told members, I said, all right, if this stock gives a sell signal up here at around 2.5, 2.6 intraday, so that's on the 1 day, 1 minute. This is on the 1 year, 1 day time frame. Then we'll short it. And really what that's telling you is that since we have these huge shadows here, as you can see, huge shadow, huge shadow, huge shadow, you look at this stock immediately, you say, this doesn't hold gains. You know, I'm not looking at some kind of crystal ball that's telling me, okay, this stock doesn't hold gains. Well, how do you know, Ferris? The huge shadows. Okay, a lot of people don't want to teach you how this works because they want to be faster than you. And that's what stock trading is all about. It's about being faster than the guy next to you. It's about being faster than everybody else out there. You know, regardless of your technical indicators, regardless of whatever methods you're using, candles will tell you how you can improve your execution. Okay, so we know this stock isn't going to hold its gains. We're looking for a sell signal intraday. And, you know, once we get that sell signal, which I believe was around 11:45, you can see that that's a good entry point to enter short. You short it down and, you know, you made a good chunk of money for the day. 2.5, you know, mid 2.5s down to mid 2.3s. It's a good chunk of cash. Okay, so this doesn't just apply to penny stocks. This applies to any stock. Okay, so any stock, mid cap, large cap, any ETFs, any commodities, whatever. If you know that they have a bad history of holding gains, if you know that there's a lot of sell pressure from the upper shadow on the candle, then you can actually get in at a better price. You don't jump the gun, and you nail your entry and exit points. So while there are pros to this, there also are definitely cons. Con number one, you can easily get scared out of a stock if you're just staring at the candlesticks. I mean, just an ugly doji on big volume is enough to make you sell or buy, you know, or cover your position. But, you know, these shorter time frames can kind of be misleading. You know, it's a lot more meaningful on a 1 year, 1 day chart, you know, or on a 15-minute time frame, whatever it may be, than a 1 minute. And I can show you exactly how that works right now. So another chart that I wanted to take a look at was DGAZ. So DGAZ is a leveraged ETF, so 3 times leveraged, and it is, you know, just the inverse of natural gas. So when natural gas drops, this goes up. And I spotted a nice setup on natural gas for, you know, a drop, a little double top setup, and I took some long. Now somebody was telling me, Ferris. He's looking at the 1 day, 1 minute chart. He said, this is an ugly doji, and the next candle is saying that we're dropping lower. Okay, first of all, this doji isn't really in, you know, that worrisome. It's not on huge relative volume. And on top of that, we've been catching pretty choppy price movement from this ticker the entire day. So that being said, this doji is not too worrisome. It shouldn't scare you out of the stock. Now, some traders who are new to candlestick charting might get scared out, especially when we surpass the lows of that doji. But, you know, it's no reason to actually get scared out. What really matters is these formations on a longer time frame. So if you're a day trader, you might say, oh, well, this doesn't apply to me. Why did I just waste 20 minutes watching this crap YouTube video? And it actually does, because if you're looking to, you know, go long on natural gas, or, you know, if you're looking to short crude or whatever it may be, we look at the crude futures for the past year. Say, you know, after this day or on this day, you're looking to go against, you know, crude. You're looking to short it. You bought puts on USO, whatever it may be. You got a nice game plan and you're ready to go. This lower shadow, this formation here, this spinning top, indicates that we are going to get a push higher. Okay, so that being said, if you went against crude here, you obviously got screwed. And this ended up being the 52-week low for oil, and, you know, it ripped from here. And that formation could have been spotted from a mile away. You could have noted that it was not wise to go against crude at that moment. And, you know, it would have completely erased your trade idea or given you a good trade idea. All right, so you can get scared out of stocks. It can also give you a good reason to enter a stock, or, you know, help you avoid missing a trade. But at the same time, one thing I want to stress with the shorter time frames and with stocks that can be pushed up and down by just a few people buying and selling, so specifically low floaters. You know, so for TAT, if a couple people wanted, this stock could have been, you know, hanging out near the highs. And it wasn't this candle, but this is just a potential hypothetical example. Could have been hanging out near the highs, and then at the last second, a couple people just wiped out the bid with the proper sized order and dropped it down. Now, this could scare out a ton of people on the next candle, which it did, just with this manipulation. So on a new high, a lot of the times you don't see the bid follow the stock up. So a couple people knocking it down could have scared you out and scared everybody out and ended up, topping the stock. So that created a ton of sell pressure from what it seems on the 1 day, 1 minute chart. But in reality, it could have just been a couple people selling. So the problem here is not just the manipulation behind it. The problem here is, the sequencing. We don't see what happens every second of this minute-long candle. Okay, we only see what happened overall for that minute. Now, you can probably, with certain charting platforms, take this down to the 30-second candles or 15-second candles or whatever you want to do. But overall, if you just watch the stock, you should still be able to get a pretty decent idea. So sequencing isn't really that big of a deal. Okay, but, back to the actual webinar itself, just a quick review. So we have the body and shadow of the candles. That's the two crucial parts that you need to understand. Open, closing price. We have the different candles here that you can analyze just to get a feel for how much buying and sell pressure there is on each one. And then the dojis that indicate a potential reversal coming. These are the different positions, and the starred ones are the ones that I take into account. The importance of candles, obviously the pros is you just get a better picture. You can analyze them and get a better execution. And then the cons, they can scare you out if you're using too short of a time frame, and also people can manipulate the lower float stocks. Okay. If you guys enjoyed the video, you learned something, then feel free to follow me on any of these platforms. You can subscribe to the YouTube channel because I'm going to be putting out a ton of more free videos that will be educational, covering all kinds of topics. And if you have any questions, comment them below or reach out to me on any one of these. And I'll be happy to answer them and help you out. Thanks so much, guys.